Okay, good afternoon, everybody. Welcome to our second webinar for May with regards to emerging market debt. For those of you who don't know me, my name is Jonathan Wu. I am the Chief Investment Specialist for the Premium Asia Funds Management Group. Very happy to give you guys an update, especially since our roadshows in late March were very well attended. And so I thought I'd give you some progress updates, especially on a couple of trades we actually did during the roadshows, which have been very good at adding some marginal value to investors' total return profiles. So jumping straight in, just to recap what we do. So we sit in a very unique space. It's a space that's not offered very much in Australia. And recently we've seen another 2 emerging market debt funds actually close in the Australian market because one of the things that we found quite early on, and this fund now has a 12-year track record since it was launched in 2011, is that none of the strategies around emerging market debt were actually Sorry, my slides are actually not showing. Just been advised, give me one sec. Don't know if that's showing. Okay, apologies for that, slight technical issue. Now you'll know how good I am with technology. Okay. So just recapping this, so with regards to the emerging market debt space, one of the things that we profess ourselves in doing is to ensure that we actually build all our strategies that are tailored to the Australian and Kiwi markets. And as I mentioned just before, that 2 of the emerging market debt funds, of which there weren't very many anyway available, have also now folded in the Australian market, primarily because of the fact that they were never catered to the Australian investor. Because as we know, when we deal with global equities, investors are far more tolerant, and advisors therefore also far more tolerant, including myself as an advisor, of the impact of foreign exchange on total return to clients' portfolios, okay? Because at the end of the day, equities are long-term growth assets, and hopefully those will wash out over time. But with fixed income, if you are looking primarily at deriving an income stream from those investments, one of the things that you're trying to do as well is to ensure that your income is protected while trying to not let foreign exchange be a huge factor in swinging the total return of the portfolio. So with our fund, it's always been built for an Australian audience all the way back since 2011. And so it runs an active hedge against USD because all our bonds are held in US dollar terms. And what we are is effectively a high yield fund. So I'm not going to sit here and say that it's, it's an investment grade fund. It certainly isn't. But the problem historically with investment grade funds is that it hasn't provided the alpha that you need in order to generate a good attractive total return for investors. So what we do is primarily high yield, which you see there in the sort of blue ball, and then we do some AT1 trading, which is, I'll talk a bit about that in a minute with Credit Suisse. We hold a little bit of investment grade where we see it's relevant. So at the moment we're holding around 10%, 10 to 15% investment grade debt, where it's attractive yields, but quite safe. And we have the ability to go up to 6 to 7% of the total portfolio to go into special situation. Special situations are not necessarily distressed debt, but they could be event-driven where the market's actually just dislocated. And I have a couple of examples of that later on in today's update. We pride ourselves on fundamental research. Just like on our equities team, we don't actually follow major research houses, whether that be Moody's, S&P, or Fitch. Sole reason for that is quite simple. We don't believe they add any value into forecasting what's going to happen in the future. Remember, at the end of the day, research reports have to look at what's happened in the past and then based on a rating of what's happened on the past, not really forecasting what's happening in the future. So if we consider, historically over the 12-year track record of the strategy, one of the key differentiators is that basically every time we see sectors or industries being downgraded, we're generally buying it, because that's generally the bottom of the cycle, right? Something happened historically, they get downgraded from a research rating, everyone sells out, which creates an arbitrage for us to be able to go in and buy up, right? So you can call it, to a certain extent, a counter-cyclical fund. In the last 2 years, it hasn't been a counter-cyclical fund because it's been frankly, the fund has faced certain headwinds, and we're certainly not hiding away from that. Relative to benchmark, we've outperformed very strongly. It's still been negative, but it has been very, very strong against the benchmark, which reflects our active nature of our portfolio. When you're in an environment with a great purge, it's not simply something that you can just completely avoid. So through our bottom-up analysis, through our 6,500 company visits between the equities and the fixed income team, we do bottom-up credit analysis down to about 200 issuers, which gives us a good triangulation on what we want to make up in terms of our portfolio. Our portfolio management team in of itself is also quite unique in the sense that we have a lawyer on the deal team on the right hand side that you can see there. And the reason for that is companies can always be sort of quite tricky in the way that they structure debt. Can people hear me? Because, okay, all right. I might stop sharing my webcam because it's saying that the connection with GoToServer has been disconnected. Okay. Yeah. Did my slide just transition to distribution track record? No, that's interesting. Okay, so we're still on the fixed income investment team slide. We're not on that either. What are you guys? Sorry, I'm just gonna. Okay. Hey everybody. It seems that the GoToWebinar platforms actually seems to have crashed because it's not sharing my screen properly. What I'll do, what our team's proposing to do is that we'll actually record this webinar separately. And then what we'll do is we will send it out to everyone via email. Yeah, I think that's probably the best way to do it. So apologies for that. The platform has crashed somehow. So, oh, sorry, apologies. Okay, just as I said, what we're proposing, it seems that things have now gotten back to normal. Okay. All right, so just give me 1 sec, everybody. Okay. So, just want to gather my thoughts again. Yes, okay, so we're talking about the fixed income investment team. One of the unique parts of our team is the fact that we have a deal lawyer on the team on the right-hand side that you can see there. And the rationale for this is we have seen over history, especially in the Asian credit market, that there are a lot of dodgy operators. And the way that they format and construct their deals can be very, very adverse to investor outcomes, especially around cross-collateralization as well as cross-default. So the job of Alvin is to actually cross-check the terms of these bonds because bonds are not traded in the same way that shares are traded on an actual stock market. You are relying on the power of your dealers and the relationships that they have in order to be able to find who the actual holders of the bonds are and then propose to them, can we do a trade? So everything is basically done via Bloomberg in that sense. And that's something that I think most people need to understand with regards to bonds. And this is not Asian bonds in general, this is bonds globally in whichever market that you invest in. one of the targets of our investment philosophy on the strategy is that we've taken the Value Partners flagship strategy and basically de-risked it. So that's something that you can also be rest assured in the way that we designed the mandate for this portfolio. So what you can see on this slide is that this is our distribution track record. And when we launched the fund, we stated that we would target a 6% distribution per annum paid quarterly. And what you can see here is that we have not ever gone below that. So effectively, the years in which the fund pays more than 6% is those years where there's more accumulated capital gains within the portfolio, and therefore we pay out the excess, what we call the bullet payment, at the end of the financial year. Other than that, you'll generally see a pattern of just 1.5% per quarter all the way through to the end of the financial year, and we expect that this year will be the same for FY, so Australian financial year 2023. We've paid out 3 quarters, and we expect to pay out another 1.5% for the portfolio at the end of June, and you'll be able to see in a minute why we'll be able to do that, because the cash yield is sitting very, very healthy. Again, just like on the equities market side, one of the key benefits of investing with us is around correlation. So what you can see on this slide here is really looking at the correlation of our strategy in of itself against major fixed income indices that you may invest in. And you can see here that even against US corporate high yield, because our fund is predominantly high yield, it has a correlation of less than half, just less than half. But even then, it's quite moderate in nature. And if you look against Bloomberg Global Ag, which is actually 50% investment grade and 50% high yield in terms of its makeup, it literally has a 0 correlation. And against Australian fixed interest, also a 0 correlation. Now, to be clear, a low correlation doesn't equate to returns. It just means that you have the ability to diversify your portfolio, which overall will reduce the volatility of your holdings across your fixed income spectrum for your investors. The other thing to note is that, you know, we are also the largest emerging market debt fund available in Australia and New Zealand. So rest assured that not only do we run the largest China fund, but we also run the largest emerging market debt. And so therefore we have the collateral capital to be able to negotiate with bondholders and bond investors to derive the best outcomes for your investors. The rate environment, as we can see here, is we're getting pretty close to the peak. So looking at especially the China position, it looks very, very different compared to pretty much every other country on this slide except for Japan, because this chart effectively denotes the expected rate by the 3rd quarter of this year versus the current rate and where everyone started at the beginning of calendar year 2022. And what you can see here is that, you know, we've gone at a pretty rapid pace to go from where we started in 2022 till now, but we're very much getting close to the end of this rate hike cycle. And what that reflects is 2 things. One, the natural or the gross pre-inflation yield, or the non-real yield, is getting quite attractive. And as inflation comes down, and prior to rates potentially being cut, which is now what's being priced, especially into the 2-year US Treasury market, is that they're pricing in 2% rate cuts by the middle of 2024. And if employment actually, unemployment in the US goes up by about 50 basis points over the rolling 12-month average, that has a 100% probability of defining that the US will hit a recession as well. And so that's something that you also need to plan for in terms of your investments in bond holdings and other sort of debt instruments for your investors. And for us, we hold all fixed rate bonds within the portfolio. So that's something important to note. So historically, the bonds that we held are at lower rates. The newer ones haven't changed a great deal. And, you know, going to the future, we're going to be sort of sitting pretty with higher rated bond yields as rates potentially will come off going into 2024, especially in the US. One of the things that has been greatly helping the confidence of investors going into Asian credit, which is where predominantly our holdings are in, is the consequence of what we refer to as the Great Purge in the property debt space. What you can see here on this chart is effectively the rating distribution of the JASI high yield bonds. So JASI is the, I guess, the predominant index looking at Asian high yield. It's the JP Morgan Asia Credit Index. And what you can see here, and what's most important, is the green part or the green proportion of the slide. And effectively back in 2018, it was about 30% of the market. And now it's actually around 50% of the market. And what's important is that you can see the orange part, which is sort of getting close to junk bonds. That proportion of the market has shrunk greatly. So the question is why? The reason is really due to the Great Purge, and we're going to go and talk about this in a little bit more detail in a minute around the property market and where we stand on it, because it's very important to realize that what's remaining in the market is what we call the survivors. And the survivors is the groups that have gone through the Great Purge and have come out the other end stronger. So if nothing else, one of the things that this proves to the market more broadly is that it is now the safest time to ever have been in Asian credit. And while the market still remains dislocated, which is exemplified by this chart here, looking at spreads, what you see here is that even after the correction, right? So if we go to sort of the tail part of 2022 calendar year, the spreads of Asian high yield against risk-free rates was sort of 1,500 basis points or 15%. But that has come right down, and that's reflected through that correction, the positive correction we saw in the fixed income markets, and now it's sort of reverted back up because it's a little bit risk off again. And what you see here is that spread against Euro and US high yield still gives you a meaningful 500 basis points in terms of total yield, which is, you know, a positive for investors seeking an exposure in this space. If we also consider the standard deviation, and sorry, there is a typo here, it's supposed to be 1 standard deviation, not 3 standard deviations, because it was 3 standard deviations a couple of months ago, is that this is data ending April. And what you can see here is that we're now back to about 1 standard deviation. Again, this chart reflects same sort of similar pattern as the previous one, but what this is looking at how many standard deviations is it cheaper compared to historical numbers. And what you can see here is that for China high yield and Asian high yield, it's still more than 1 standard deviation cheaper than its long-term average, as you can see through this data here. If we turn our eyes to property, and I want to spend a little bit of time talking about this because we have some interesting holdings now in our property exposure, is that we have around 22% in China, and a reasonable amount of that is in the property sector. The government obviously has had a massive turnaround in terms of the 3 red lines turning to the 3 red arrows. So from coming from being a very restrictive policy setting to being a very much easing policy setting, but easing within the perspective of that we don't want to go back to the old days of having property companies go hand over fist, borrowing more and more money and over leveraging themselves. But now there's another problem that has arisen, and that comes down to your ability to complete really high quality fundamental research. And the whole game, in our humble opinion, is around the quality of land bank. So you think about the fundamental business of a property developer. They develop property to make a margin, and what do they need to do? They need to move on to the next development, right? It's not an annuity income stream. They need to have a deal team that continually looks for blocks of land and buy land, then hold on to it until it gets DA'd, develop, move on to the next one, rinse and repeat. The problem is, if you are under a very restrictive regime, or you are a company that was far too heavily leveraged, you actually have no capital to buy the next block of land. If you don't have the ability to buy the next block of land, what are you developing? If you're not being able to develop, your company is going to go down in a fairly quick manner, right? Or you're going to contract, at the very least, contract your business operations until you can enter the next cycle or find a relationship where you can actually borrow money again. So this brings up a really interesting topic, because our top 3 property developer holdings in our portfolio is Hobson, followed is Hobson, as well as Country Garden, and a third one, which the name escapes me right now, is based in Hong Kong. The three of them have three separate reasons why we're happy to hold them, but they're all around the same similar scenario. It's around liquidity or land banking. So say, for example, if we consider Hobson Development, the land bank for them is currently 9 to 10 years, and its credit rating is relatively strong. Now, why is this important? If you hold a developer that has 2 years of land bank left to develop, but you're holding on a 5-year bond, you've actually not got what was traditionally called an asset liability mismatch, but you actually have a cash flow mismatch because they won't have any cash flows after 2 years. So 3 years after the next 2 years, which is when your bond actually is looking to refinance or looking to mature and get your capital back, that's not going to happen. And this is the fundamental problem with a lot of the developers that we're holding. So Hobson, as I mentioned, is our top holding in the development space. They've got 9 to 10 years worth of land banking, and the debt or the bond is trading at around mid-80s, right? Country Garden, another one, they've got developments in Australia. They're in a separate basket. They're too big to fail. They're in the basket where their credit is reasonably strong and their debt financing lines, again, all around liquidity, is strong, right? On our fundamental research. They're short dated bonds as well. And some of them are actually looking to mature in calendar year 23, and they're trading at 70 to 80 cents in the dollar, which again makes no sense to us, right? So their banking relationships are very strong because they're a blue chip company. The third one, which is So On Development, which is a Hong Kong development, is all around high quality developments, both in Hong Kong and in China. And they have very, very strong relationships. And also they're a very, very strong financially stable developer, right? Short date, calendar year 23 maturity. They're trading at about $98. So we're actually only at 98 cents in the dollar. So we're only picking up for yield. And they've got some longer dated ones which are trading at 80 to 90, which is the other reason why we're happy to hold it, right? All three developers are in the money in terms of we're making money against our price. But in terms of our total property exposure, it's all but 1.5% is China. That 1.5% is actually Indonesian property. Okay, so to give you an idea of our philosophy around holding property companies, around being survivalists, one big impact, just to recap, of being a survivor is that you've got a strong land bank or you have strong relationships to acquire credit in order to buy your next block of land in order to do your future developments. We've also seen a turnaround in terms of month-on-month prices in the top 70 cities in China. So that's generally your benchmark that you're looking at, the top 70 cities and the prices that they're deriving at the moment. And primary sales have actually started to turn a corner. So you can see the primary transaction market that has started to pick up year to date on a year-to-year basis. So last year, it was sort of stop and go. We were still in lockdown for the early part of last year, but month by month, that has strengthened. And in the early part of this year, it's actually been quite strong, as you can see there. So this chart sort of summarizes from another frame why holding a land bank is incredibly powerful. You can see here that if I go to the right-hand side of the chart, if you're a B or below or not rated developer, when you look at your 2021, right, property sales to 2022, right, one part of the reason why it fell so significantly was on the back of the fact that you had nothing to sell. You have nothing to sell because you couldn't complete any development, right? So one part is land banking to be able to produce more property in the future. But then on the other hand is that if you can't produce, then you've got nothing to sell. So you may have a weak market, right, overall, as you saw in 22 calendar year. But the other factor market is you've got nothing to sell because you're a low rated developer, then your problem is still similar. Whereas you can see that in the triple B, so the highest investment grade players, they only dropped a quarter, and then naturally your double B dropped more by about a third. But B or below dropped 2/3 in terms of total volume. So that's something that we're also very cognizant of when we're looking at the debt in the property space. In terms of some sort of key strategy updates on the portfolio, we continue to strive to build a well-diversified portfolio paying a 6% distribution per annum on a quarterly basis to your investors. The China macro scenario has improved. Services PMI is probably the part that's sort of taking the lead at the moment. And obviously 2023 Q1 GDP growth also surprised on the upside. With China property, as I mentioned, we're still sticking to the theory of buying the ones that have the ongoing survivability. We actually added another Macau name. So for those of you that have been tracking our strategy in terms of where we're allocating capital to, in the tail end of 2022 calendar year, we had a reasonable exposure to Macau, which is still there, on the basis that all the licenses that were coming up for maturity in that space were coming up for maturity. And what we did was we bought into it because there was an uncertainty as to whether or not the government was going to renew all the licenses. After our own bottom-up research, we felt that we were quite comfortable in taking on that risk for investors, and our thesis came true. Everyone got renewed without any issue. And now that Macau's reopened, we've now added another casino name to the portfolio in order to pick up again a very strong yield. We've actually taken profit on India. So a lot of the names that we had in the portfolio from India were around new energy or renewable energy. The reason why is because it goes back to this theory that there's good investments, but you don't want to be holding it or buying it at a bad price. And all the Indian names are pretty much now at par. So that now to us has become expensive, and hence we've looked at ways of redeploying the portfolio. In terms of that AUD hedge, one of the things that we always say is that there's a correlation between effectively, the MSCI Asia ex-Japan index on the equity side is highly correlated to the performance of the Australian dollar, okay? Because mainly if China's doing well, the AUD is going well as well. Now, obviously, in the last 12 to 24 months, there's been a slight shift in that situation because obviously the US rate rises have, sort of thrown an 8-ball along with the great purge of the property market in China. So there's been a dislocation in that relationship. Now, post that dislocation, and now we're past the great purge, there's also no clear direction of the US AUD relationship in Gordon and the team's opinion. And therefore, what he's done is that he's kept the hedge at about 56%, which gives us a bit of carry because obviously US rates are higher than Australia. But then when sort of taking a sort of a halfway approach with regards to the level of hedging. There's one question that came through here that I'll just quickly answer. So please clarify that if the 1.5% of the valuation as at end of quarter's end or the end of the previous financial end. It's the valuation as at the end of the current quarter is how we measure the 1.5%. Yep, so it's against the NAV of the fund. Please keep sending questions through if you have. I'm just monitoring as we go through. So the fund sits at about $85 million, the largest in both Australia and New Zealand, and we're paying that quarterly distribution of at least 1.5%. The way the portfolio is currently sitting is that the cash yield is sitting at 7.5%. So that's against the current market value of the portfolio. So 7.5% allows us to very much comfortably pay a 6% distribution to investors without having to take on an excessive level of risk. As I said, this portfolio actually is Value Partners' best performing portfolio in their fixed income stable. And the rationale for that is because it's well diversified and it's also de-risked against their what we call flagship strategy, which actually targets an 8% distribution. So by targeting 6, we've actually reduced a lot of the risk and we don't have to push so hard because investors are actually very happy with 6% cash distribution of a fund that correlates with nothing else in their portfolio. The duration, and something I always remind investors, this is a fixed rate bond fund, which means that duration from the traditional perspective of sensitivity to interest rates is not high. You have to remember that this fund is very sensitive to credit events, right? So credit market liquidity, as well as credit risk. That is how risk is represented and manifested in a strategy like this, not the sensitivity towards interest rates. And the years to maturity weighted average on the portfolio is also not long at about 3 years. And the yield to maturity is still sitting at 17%, which is a nice, healthy spread of around 10% between that cash yield to the yield to maturity. So if you want to simply put it, effectively on average right now, in very general terms, the portfolio is trading at about 90 cents to the dollar against the par value within the portfolio. And then what you see here is that in terms of the sector and geographical exposure, the fund is also fully deployed. Just like our equity strategies, we are fully deployed because the opportunities are abundant in a market that is still dislocated. And I want to make this point really clear. It's dislocated, not distressed. Distressed was more 12 months ago, right? The economy's reopened, the credits are performing, but it's dislocated because people are still trying to price the bonds. But because we've done all the fundamental research before, this puts us in an optimal position to already be ahead of the curve and deploying the capital. You can see that our exposure in China and Hong Kong's increased slightly at the expense of India. And what do you see? And what you see here is that you can see that the India exposure has now come off at the expense of the China, Hong Kong. Indonesia has stayed relatively stable, and Macau slightly increased because of that additional 1.5% we've deployed in a new name. On the sector exposure side, you can see it's very well diversified, right? So we will never ever stand to be a real estate bond fund. That's never been our purpose. But if the market is attractive at that point in time, yes, we'll deploy in that space. The energy sector has come down, and because mainly that was our Indian exposure, and that's been redistributed across most other gig sectors. So you can see that this is a very, very well diversified portfolio with over 100 bonds. If you look at our top 10 now, you can see there, as I mentioned, I talked about Hobson Development, Country Garden, and so on, which is number 6, number 8, and number 9. And those are holding at around 2%. So if you think about the real estate holdings that were holding at about 26% of the portfolio, the top 3 are only sitting about 2%. So again, we're also being very well diversified to protect your investors in order to be able to hold a wide range of property developers, which we think are the survivors, the ones that have got really good land banking, and that is, that's what we're holding to in terms of the portfolio there. That's all I had to say. There's been one more question that's come through. Could you discuss ESG and hold investments casinos align with ESG policy? What's actually quite interesting in the bond space is that when you're investing in the bond market, you're investing for the purposes of cash flow, right? When you are investing in the equity side, yes, is much more of an ESG focus because you're looking for the future growth of the company. We're not funding growth of the company, we're funding cash flow of the company. So the ESG consideration is actually less. We're also very clear in terms of our ESG approach, both on equities and fixed income. And what I mean by that is we're not an impact fund. We've never professed to be an impact fund, and we don't intend on being an impact fund. So we're not trying to, greenwash, and we're definitely not trying to be that and trying to, effectively lie to you that we're trying to do that. One of the things that we're seeing in ESG, which is very different in the Asian market compared to Western markets, is that there is very little reporting on ESG matters, right? And it's something that's far behind, especially Europe. From our ESG standpoint, we've built our own frameworks around ESG in order to be able to try to generate and capture some data by looking deeper into the companies. But where we use ESG to contribute to our investment process is really around the risk rather than the return. So if there is an environmental risk or social risk of a company, for example, that we see and model as a financial risk. And as it models as financial risk, then we'll generally not invest in a company like that. So yeah, that's what's been happening. Another question that's come through after a strong end of year, 2022, funds been relatively flat. How come? Yes, the market's been actually quite reasonably quiet. And that's reflected in a couple of the charts earlier around the standard deviations. Yes, it is still one standard deviation cheaper. but the market is also cognizant of risk. People don't forget about risks within months, okay? And it means that the opportunity to still be invested, or clients that haven't been invested, this is actually quite an attractive time to capture that. This is why I call dislocation not distressed. A dislocation situation is people are trying to reprice the market but don't know how to reprice because they need more data. We believe we've already repriced it in our models, and hence we've exposing your investors in that way. We just feel we're ahead of the curve in that sense, and we have a 12-year track record to prove that we've been doing that. So I hope that answers that question there. I don't see any other questions come through. I'll be in New Zealand at the tail end of July, early August. So for those on the call that are from New Zealand, Clayton will reach out to you to catch up, and I hope to see a lot of you then. Otherwise, we'll keep running these webinars into the new financial year. And with that, I hope everyone has a great rest of the afternoon. Thank you.